welcome to the Monday Futures Market Outlook for March 19th, 2012. This is Patrick Svrezna. For those of you that have not had the opportunity to try out the eminisource.com trading room, complimentary memberships are available at request. As always, we start off with a chart of the US dollar index futures, and we certainly had the US dollar strengthen over the last couple of weeks before the last few days of selling. Really at this stage we remain bigger picture optimistic the US dollar, but it doesn't mean that the US dollar doesn't have to go through a little bit more basing before taking off. And really at this stage we wouldn't be surprised if there was solid retesting of the 79.80 zone during this kind of little consolidation throughout the week. But it is our anticipation that almost all selling should be contained to that 78.50 area, creating the buying opportunity on the upside of the US dollar. Next here, when we take a look at the Euro FX futures, we had a support line come in along the lows that occurred in February around this 130, 131 level. Now that marks a very important downside pivot. At this stage, the Euro is bouncing off of those lows, and we actually think that there's room for the Euro to come back and even retest the highs that they put in the month of February. Initially, we'll be watching first rallies up to the 133 area on the upside, but if there is follow through, then even testing of the 135 is certainly possible. In the bigger picture, we still believe that there's another round of substantial euro selling coming, but at this stage, in the short term, there is definitely room for the euro to have a little bit of a pop. Next year, when we take a look at the 30-year Treasury bond, with that 140 level that we've been watching on the support line gave out, and when it did, the selling on the Treasury bonds became very intense. It came all the way down to the lows of October, which we now are marking off as the 135 to 136 focal point. Really at this stage, this is actually satisfies our initial downside targets for Treasury bonds, but it will be interesting to see whether or not there is still follow-through selling. At this stage, there is going to be some sort of a short-term bounce in Treasury bonds, so don't be surprised if you see the 137, 138 handles tested right in here. But if we see any rejections, there might be a chance that there's still going to be another round of selling coming in Treasury bonds. Once we see price action stability, we'll revisit them to see whether or not there in fact will be a buying opportunity there. Next year, we're going to take a look at copper futures. Copper put in a double top type retest along the $4 mark on the upside, but as it sold off, it really did still find support around 370, marked off by that blue line. We rallied all the way back towards, again, that overhead resistance at 390 to $4. And we're going to come up to a very important point of information. Really, in the end, if we see any break above $4 on the upside of copper, it means that there still has to be one more leg played out on the upside. That would initially be targeting the 420 level on the upside of copper. But before we start becoming bullish on copper, we are very carefully watching this very overhead resistance, because anything that forces copper to reject here, and particularly if there was a breakdown below the 370 level, it would immediately turn copper charts substantially bearish. And so remain relatively neutral. You can swing trade copper breakout above $4 on the upside for a move up to 420, but be very careful of any substantial weakness below 370, which would take us right from this kind of more neutral stance to an outright bearish stance on copper. Next year, I want to take a look at crude oil, and when we take a look at crude, it actually shares some similar characteristics to the copper chart, as it's now trading back up toward the top end of the range of where it was trading in February. Really, at this stage, we literally can draw in a line along these previous highs around this 108 level. If we have any crude oil breakout above that zone, then crude oil goes right back to being bullish, and that would open the window for a move that could potentially even see the 112 to 116 level tested on the upside of crude. Again, crude is actually probably the most bullish of commodities right now, and if there does make that break, then there's certainly room for crude oil to follow through on the upside. In order for us to really start becoming far more concerned about crude oil, we would need to see a round of substantial weakening, and there's just simply no indication of that. So right now, the trend that's been in place, which is higher, is still very much in control, and therefore we certainly could see a further strength in crude. Next here, we're going to take a look at gold futures. I circled in what I think will be an absolutely crucial moment in the prices of gold. Now, gold has substantially weakened off that 1800 level, but has really come right into a key retracement zone, and this becomes truly a break it or make it moment for gold right at this level. If this 1640 is 1630 level can contain the selling, and we see a bullish reversal back towards, let's say, 1700 on the upside of gold, then that would mean that there could still be another round of buying in gold that could potentially see us return right back to the top end of the range. But in the same regard, if we see any follow-through selling that breaks gold to a lower low than its previous 3-4 days, basically a new week low, that would immediately put in substantial selling pressure that would have us trade right to the bottom end of the range, down at the 1540 to 1560 area, and all of it will literally come right off of this very price level. So we're as traders watching this price action on crude, on bullion right in these levels, and if we have a break in either direction, they will represent a trading opportunity. So that brings us to wanting to look at the S&P 500 charts, and as always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles we've gone through. On the most recent push last year, we had that level numerous times broken, but we remained distinctly trading above the 80-week moving average, with it pointing higher, indicating that the market remains in bullish trend. And at this stage, there's no immediate way that this could reverse and change that trend. That brings us to wanting to look at the daily chart version. And while the weekly charts remain relatively bullish on that front, the S&P 500 and the daily charts is very much reaching short-term upside targets. And we've been looking for a market correction for over a month, and the market defies that and continues to push higher. At this stage, even though we've had this really nice bullish push in the last 5, 6, 7 trading days, realistically, we're approaching a level where even our yearly upside targets have actually been fulfilled. This 1400 to 1450 zone marked off by the blue box is going to be a very interesting level. While now 1400 being a round number could be a turning point here, there are a number of measured targets that do focus on 1420 to 1440. So there definitely is room for this week to remain a little bit optimistic. Once this move finishes, and it could come right off this level, or it could come off another 30-40 S&P points higher, but there will be some form of a market correction that will be substantial. Now, when I want to emphasize it being a correction, because I don't necessarily believe it has to be a crash or a bear market at this stage of the cycle, but looking at market corrections that have occurred in the past couple of years that have come after a substantial move like this, it now is not unrealistic to have an expectation of even 100 to 150 S&P points off these highs at some point. That would constitute something that would be even up to a 7 to 10% market correction off of these highs. More than likely, that will represent a buying opportunity, but it will be a painful correction when it does begin. But it doesn't necessarily have to begin this week, and we may further still see upside potential in the markets before that bigger correction takes a hold. just to make some key intermarket observations, we are very neutral on the markets here on the short term, which means that we don't necessarily believe the US dollar has to do anything big in the next month. Commodities, we are, other than crude oil, being relatively bullish when it comes to broader commodities, everything from copper to the precious metals to a lot of the foods. There's a lot of toppiness and a lot of overhead resistance levels on so many of them, and so we while we're not bearish on them yet, we don't necessarily have a lot of upside targets for them to go further. In the same regard on bonds, even though they have distinctly broken lower as we anticipated, we don't necessarily believe they have, unlike what is being touted in the media, we don't believe that they have to have a lot of downside potential, and therefore now that we've already reached those lower targets, we remain relatively neutral, even though there is definitely some short-term downside momentum that could see a little further weakness in the next week or so. On stocks as well, because we're approaching all of our upside targets, we are relatively neutral, but on the long term, particularly on stocks, we want to emphasize we don't, even though we're looking for this correction, we don't want to term it bearish on long term, because we believe that market correction will still represent a buying opportunity, and we feel it would be inappropriate for us to give a bearish bias necessarily, but we feel that there's overall very limited upside potential in the stock market and very little incentive for traders to remain long this market. That was your Monday Futures Market Outlook. Thank you for joining me.